Everybody, welcome to tonight's presentation on advanced tax strategies. Thanks for those that came out in person. Thanks to you online. Sorry, I'm a few minutes late for the online folks. Tonight's presentation, I'm going to try to keep it to that 20 to 25 minutes, which is about all anybody can stand when you're talking tax strategies. But I'm going to zip through the first part. So when you think Steve is going way too fast, that's the basics, which is we're gonna talk about advanced. I'm just really hitting the high notes of some basic stuff up front, and then we'll get to the advanced stuff towards the end. The purpose of this whole presentation, though, as you can read the disclaimer thoroughly here, I'm not a CPA. I'm a financial advisor, so I set you up with, if you hear something and say to yourself, that sounds like me, that means do some more research online, reach out to your advisor, and ultimately we have Michael here with us, is our partner CPA who can also talk in depth about these sort of strategies. So tonight is more of just an awareness that something exists, so you can get that feeling of, yes, that sounds like me. I need to get smarter about it. Excuse me. So here are the basics, if you will, of the tax strategies. These are things you probably already know. These are things that we do for you if you're a client. And we'll go through each very quickly. The 401k, again, that's through your workplace. There are some limits. The goal is, if everybody could, you max out your 401k at work. If you get an employer match, take the free money, right? And try to max that out. If you do that enough, you should be enough to, if you start when you're right out of college, you'll be a millionaire in your early 40s, is how the math is set up. The discipline to do so is up to you. The benefits, you may get free money from the employer, but you're also locking money away from yourself, some of that self-enforced discipline of, if it goes right out of the paycheck into my account, I don't have the temptation to go out and buy a Tesla or something like that. As far as the pros and cons against tax advantage, depends on what type you use. That's up to you, whether it's traditional or Roth and what your employer offers. The cons is it does tie your money up and you do have limited investment options. So it's not my first choice, but certainly it's something you should take advantage of. What is my first choice is the IRA, individual retirement arrangement, is technically what that stands for. The maxes are on there; they're not very high, but remember, if you're married, you can do this for you and your spouse, even if you're the only one working. So you get credit for a stay-at-home spouse. Both of you can do this. You should set these up and max these out every year. A lot of the people will say I should dollar cost average into these, and I think that's a great idea. You can do that either dollar cost averaging on a monthly basis or just do it every January, which is dollar cost averaging on an annual basis. Either way, you get the money in earlier, so it's working for you. If you have any questions, reach out to your advisor on that. There's traditional and Roth. Traditional, you get a tax break now. Roth, you don't get a tax break now, but you never pay taxes again. Roth is far superior in almost all cases. I have software to prove that if you want to challenge that assumption. But again, think about what's best for you. The HSA is a health savings account. Again, the big beautiful bill didn't really change much with 401ks and IRAs, but it did with the health savings account. It gives you more of an opportunity and reduces the how difficult it is to fund one of these. You do have to have a high deductible health plan, as you can see in the lower half of the slide, to be able to be eligible. Most people are like, I don't know. So ask HR, can I have an HSA? And they'll say yes or no. If they say yes, then you certainly want to fund these. It's the Super Bowl of investments as far as you get a break for money going in. It grows tax free while it's in there, and as long as you use it for appropriate functions, then you don't pay any taxes on the backside. So it's really the best of the best as far as the taxability arrangements. How money goes in right from your employer. You set it up at work, much like the 401k. You set it up there, and then it's been kind of a nightmare to set these things up. Hopefully, with the big beautiful bill, it's going to be a little less of a nightmare. I would lower your expectations. It's going to take some pain to get some money into these, but it's certainly worth it. And how money comes out of it is, you can have a credit card that goes right out of your account for something like that, or you can just use the deposited funds for qualified health expenses. But you are going to have to kind of keep track of it, because then once comes tax time, you're going to have to be able to report it. As far as what you can use it for, there are just a few qualified expenses on this slide, and there's a lot more, but these are kind of the more common ones. Think flu shots, hearing aids, glasses, dental needs. Thinking more of the kind of senior type expenses that you're having for healthcare needs. Okay. There's a lot of details there. I'm not going to cover any of them except for you can inherit that. It's portable to your spouse. So if you're married, one of you passes away, it's portable to the other person, gets to join up right with hers. and then the money is yours at that point. Okay, next basic topic is tax loss harvesting. We do this for you in your taxable accounts. Again, it doesn't apply to your IRAs. It's only in the taxable accounts. And that means if something is down and you call me up and say, Steve, I need 5,000 or 50,000 or 100,000 to buy my Tesla, then I look through your account, see what's down and sell that off. And then you can get those capital losses. While nobody likes losses, right? And we try to avoid that. But if you have losses in your account, we're going to take those losses, realize them, and then when it comes time to file your taxes, those can be used to offset your gains. So the math here is a little weird, but if you say have 100,000 in gains and 150,000 in losses, that's a bigger account, but you'll offset the gains one for one, so you won't pay any on the 100,000 of capital gains. That 50,000, you can use 3,000 of it towards your income, and the other 47 is a carry forward loss, if you've ever heard those terms. It's not a great situation to be in, but if you do take a complete bath in something, and whether it's the market, business, anything else that you can write off to losses, you do get to carry those forward and offset some taxes for years to come. Okay, the last thing we'll talk about for the basics is the portfolio construction. Again, we do this for you. Probably the best example I can give you is if you like NVIDIA stock, or pick your favorite, pick Bitcoin or whatever it is you choose to invest in. You want to make sure you buy it in the right place. So if you put it in your taxable account and it 20x's or 100x's, well, you're going to pay taxes on that if you ever sell it. But if you die with it, then it's going to step up in basis. So you kind of get a break there. If you put it in your traditional IRA, then it's going to grow and you will eventually get taxed on it no matter how big it grows. If you put it in a Roth IRA, then it can grow tax free forever. So it's a huge difference down the roads where you put things. So if you're with us and you wonder why we have different risk scores assigned to your taxable, your traditional, and your Roth IRA, that's exactly why. We want the home runs to go in the Roth IRA and the singles to go in your taxable account. So now it doesn't always work out that way, but that's why we're placing specific things in specific accounts. Okay, there's some different ETFs that we can use to buy and sell. So if you own the SPY, which is the S&P 500, when it buys and sells stocks within the S&P 500, you don't pay any taxes on that. If you bought all 500 stocks in the SPY because you're like, I'm going to save myself that 0.03% of that fee that they charge me, well, good luck. But when you buy and sell to keep up with the rebalancing of the S&P 500, those are taxable events every time you do it. So take the ETF wrapper is what they call it. It's wrapped into an ETF for tax advantages. We do have some risk off funds. We saw this in 2022. We saw it again earlier this year. It is not for aggressive accounts. We don't put this stuff in them, but for other accounts, if you're in the, say with us, the 5 to 6 range, and you're like, I don't like, can you wave your hand at that switch back there, Michael? You get these lights there, they came back on. Thank you. The We do have funds that have circuit breakers in them. So once they go down 10%, they stop out, right? And then they go flat, like you can see the yellow and purple. They go flat until the market goes back higher. So that's a way to reduce that roller coaster. So for those that want to do that, we can do that. And again, there's no tax implications of doing that, having those circuit breakers in your accounts. Okay, as far as the tax advantage accounts, again, we're going to rebalance those. That's blocking and tackling type stuff. And again, when we go to rebalance, we're doing the minimum amount so we don't cause you a big tax concern out there. Okay, that was a quick overview of the basics. So that's not what we're focused on tonight. We're talking about the advanced strategies. So I will slow down a little bit, and we'll spend just a second on this slide, kind of introducing each of these. Okay, these are the 6 strategies out there that if you have any of the problems, if you will, under the qualifying assets situations, these are how you can really save a lot in taxes. I will tell you that if you're at a normal type wealth management firm, that you are not going to actually get a lot of these strategies. These are more family office stuff that we have brought to you, that we've taken the time to learn about. Corey's done an amazing job of putting all this stuff together. And so we're kind of bringing that stuff to your level. You will see that there are some high minimums. So check out that slide. 100K min. These are not everyday moves that you're going to see in your life, but you are going to see this. So when you think of like capital gains, you can think of appreciated stock, like if you had Apple stock, Dell stock, NVIDIA, Palantir, Bitcoin, any of those things that have moved up at least double, you may want, if you want to take some gains off of those, then you're going to have a tax problem. There's solutions on this slide. If you have rental property that is appreciated significantly, that's another one where you're going to see some solutions on here to avoid paying the taxes or deferring those taxes further on. And then if you have a business, if you start a business from scratch, congrats. If you made a lot of money, all of that's at a zero cost basis for the most part. So everything is a huge capital gain at the end of it, and you're going to want to offset how much you give that to the government. If you don't do any of these strategies, and you think, okay, I started a business and it's worth 5 million, and I sold it, you're going to say, okay, well, 5 million, and if you have to take it all in one tax year, you can't spread it out. You got a $5 million tax bill. You take the top tax bracket, which I think is 37 or 39. You're going to lose basically that percent of the money you get payable that year. So you want to employ some of these strategies if it applies to you. The big beautiful bill really only changed one of these significantly, and that's the first one we'll talk about is the opportunity zone. Before I do that, I will say in Ankerstar Wealth, we deal with several clients in opportunity zones. So it's a great deal. If you don't need money now, if you can lock money away for a while, it is absolutely the way to go. We have one client that's doing direct indexing, and we have several clients that do the qualified charitable distributions. The others, we don't have anybody specifically in a donor advised fund, even though that's pretty easy to understand. The 1031 and 721 conversion is advanced. We haven't walked anybody through that yet. Let's dig into the opportunity zone. So this was born out of the 2017 Tax Cuts and Jobs Act. So Trump won, if you will. Immediately, the purpose of it was to try to, he has a real estate background, is to try to get funds to disadvantaged places around the United States that nobody's really hopping in and taking care of. So you think private equity is always looking for opportunities. We're from Austin, so if you think of Austin, the I-35 corridor that goes through downtown, you kind of have the have sides and the have-nots, if you will. So if you think over on the east side of 35, that was a huge opportunity zone where they were taking some small single-family homes and within this real estate project, getting rid of those, buying those people out of those properties, and then putting up multifamily or apartment buildings up to whatever level they're allowed to within the code that's down there. So basically, developing that area. So they incentivized not only the investors, which is our side of it, but also the PE firms that are coming in to do these with tax advantages, right? So they make a good deal for everybody. And these things generally kick off commercial real estate type returns, somewhere between 14 to 18%. That can vary, obviously, but that's the opportunity zone. So the tax benefit, so 100 million, or excuse me, 100,000 is the minimum. So you bought Bitcoin on January 11th of 2024 in your taxable account. You put 100K in because maybe Steve is right. Steve was right. It doubled that year. And you're like, holy crap, I have a lot of Bitcoin now. and I want to take my gain off the table. So you sell half of it, right? And so you have 100K in taxable gain. You still have your 100K in Bitcoin. So you can pay tax on that and go on with your life. Or you go, it's kind of just money I made, right? Why don't I put it into an opportunity zone? So the tax you would normally owe on $100,000 would be whatever your tax bracket is. So 24, 32, somewhere in there, depending on your income. So you would take those and you put them into an opportunity zone. You don't pay any taxes for 3 years. So it's deferred. After 3 years, the real estate developer pays you a return of capital approximately equal to what you would owe in taxes. So you think $100,000, say it's 30,000 that you would owe in taxes, you get a distribution. Again, it's return of capital, so that's not taxable. Comes back to you, you pay your taxes at year 3. And then as long as you leave your money in for different fences, there's different benefits at the 5-year, 7-year, and 10-year point. If you leave it in for 5 or 7 years, you get a reduction. If you leave it in for 10 or more years, you get an elimination. So this is right for you if you have lots of levers to pull with your net worth, money spread out. You're like not worried about, like, I can lock away $100,000. If that's the only $100,000 you have, you do not want to lock it away, because you are not going to crack into it and get this without giving back all of the reasons you're in it and paying a penalty for doing so. So you want to make sure that you are liquid, if you've used that term, enough to be able to not have to reach into this 100,000. I will say we have folks off into the seven figures that are into this. So if you're selling your business for 10 million, I mean, putting a million or two in an opportunity zone, it's going to lock the money away for a long time. You're still increasing your net worth, but you certainly won't be able to pay for things on a day-to-day basis with it. Here's kind of the timeline we talked about. There's the way they've coded this now with the new Big Beautiful Bill Act is if you invest from now until December 31st of 2026, you will fall under these current rules. If you wait till January 1 of 2027, you will fall under the new rules. So you may not have a choice when you take these gains, right? If you're selling a business, you may have to sell it now, not wait a year and a half to be able to do that. Same with real estate property or whatever. So it's still beneficial, but the new rules are even more beneficial than the existing rules. So that's something to always have in your hip pocket when you're looking at a big taxable event like this. You see the eligible assets, they're pretty much the ones I've talked about, but you have 6 months from the time of transaction to be able to make this determination. So you don't have till the end of the year if you sold your business at the beginning of the year. So a lot of times with tax things, you can kind of wait and figure this out. Just as long as I have it figured out by the end of the year, you get 180 days from the sale of the bond, or the business, or the house, or you can see land, livestock, art, wine, automobiles, any of those like collectible type things where the numbers can get big. You can do this as a corporation, so it's not just for individuals. You can do it for things that are held in a business structure of some sort, and we've done that. So there's with real estate, 1031 exchanges. We'll talk about here in a minute. With real estate, basically, you can take if you sell your investment property, make 300,000, you can just buy a bigger, better real estate property, roll those gains forward, and you can continue to do that as long as you're always going bigger and better. You're deferring those taxes. You're going to pay them someday or die. If you start playing that game, you're going to quickly bid into the I'm probably just going to hold the stuff till I die. Because the tax bill, if you eventually try to unwind that, is going to be huge. And that's why the 721 was created. We'll get to that in a minute. Or you go into the opportunity zone. Now you are out of the ownership structure of an actual building where you're having to run it as a business LLC, rental property, et cetera. And now you're handing that over to professional, private equity money that's making the money for you, and you don't have to worry about it. So that's probably the biggest advantage is it's stress-free, less stress. I won't say stress-free, less stress for you. Here's $1 million. If you walk through the two columns there, normally, if you have $1 million in capital gains, that's this column over here. You're going to pay 30% in taxes. So 300,000 is gone sometimes at closing, right? They might just take it and send it to the government, so you don't have to worry about coming up with it later. And then you go to invest with 700,000, assuming a 10% return, and these are kind of your numbers that you would see. If you do this with the same scenario, defer those taxes for 3 years, you put the full million to work for 3 years, let it grow at 10%, then get basically 30% kicked off, to which now that pays your taxes. So you're really starting at the $1 million point still after the 3 years, and then you go forward and taxes are eventually eliminated. So you're much further ahead to the $2.5 million after a period of 10 years. So your math would be different, but this is something we would sit down and talk you through. So that's opportunity zones. Direct indexing is where you take basically pick an index, which most people are familiar with, the S&P 500 index, and which has 500 stocks in it. And you think if you started on day one and you buy all 500 stocks in the S&P index, out of those 500, even if the market goes up 1%, still there's going to be a whole bunch of the stocks that went down, right? Because stocks move independently of the index. So you're taking the stocks that move down, selling them, capturing that loss, and then putting a DNA equivalent holding into that position to where now it can still, over time, acts like the index, but it's different holdings moving in and out. So why did I use those weird specific words? Well, we know from wash sale rules that you can't sell something and buy it back because you don't get to claim the loss. And you also can't sell something and buy something similar to put it in, because then that's also a wash sale. So you can't sell Pepsi stock and buy Coke. That's clear. That obviously those are equivalents. but you can sell Pepsi and buy Lockheed Martin. And so they've studied, this is algorithms and smart stuff for long-term patterns of where you can see what stocks have similar DNA. So that's what they're looking for there. So stocks move out that are losses, other stocks move in. At the end of one year, if the S&P 500 is up 8%, your holdings will be up 8% plus or minus 1%. That's like the tracking error, a little bit of noise there. But primarily, you're getting whatever the index would return. But along the way, since you've been waiting for folks to pop, or waiting for stocks to pop down and be sold, you're actually taking those losses and kind of extracting them. So, the person who didn't do it, who put 100K in, and the index goes up 10%, has 110K at the end of the year. The person who does do it, put 100K in and has 110K at the end of the year, but they also have like $8,000 of realized losses along the way because of that shuffle that's going on. Literally, when I first heard this, I'm like, that's got to be illegal. I turned to David Chisholm, who's also sitting there. I'm like, if this is true, it's got to be illegal, right? Well, no, it's not illegal. It's been going on for years. It generally goes on at the family office level, and the computing power that it takes to do it, the custodians haven't offered it really until about 5 years ago, is when Schwab, Fidelity, Vanguard are starting to say, hey, we can do this at the household level. So you're actually extracting gains, and I said, well, what if I don't have any gains to offset? And I said, well, do you plan to have gains in the future? I'm like, I do. So they're like, well, you put a chunk of money in, you buy the index, you do direct indexing, and say over the course of a year, you have that 8,000 in losses. Well, then you can just carry it forward, right? You put 3,000 towards your income because that's what the tax code allows, and then the 5,000 kind of carry forward. So they're even like somebody like myself who has a business, which is my primary part of my net worth, is there is going to be a sale at some point. So I should be doing this now to be able to use a decade or two of the direct indexing to build losses. So the eventual sale, I'll be able to offset a significant chunk of that. That's how it worked. From the one client that's done it, it has kind of worked really well because of the volatility that 2025 held. So the world ended with tariff Mageddon, and then we did have a president for the first time. Well, maybe not for the first time, but in recent history, that was a little more like, I'm going to wake up and change the stock market today with the stuff I'm saying, when nobody knew what he was going to say. So the volatility with that really allowed a lot of these stocks to move. So there was a lot of these losses being realized. So you can pause on that slide if you want to get into what actually the example it uses. This is kind of what I told you, the pre-trade portfolio and then the post-trade portfolio. Stocks that go up, if you buy it on day one and the stock always goes up, well, you'll have that same stock in your portfolio at the end of the year if it never went down. Even if it went up and then started to go up and down, and it's still a gain, so you're never going to mess with it. It's only the ones that start down that you're going to be able to use. And again, you don't do any of it. It's all algorithm based. I will say that your 1099 Bravo, though, the form you get in the mail or download at the end every year, is now like 100 pages instead of the 12 that you're used to. Tax software can import that in. You don't have to sweat that. But your CPA might look at you funny. Look at it be funny right now. Okay, so that's direct indexing again. 100,000 is excuse me, 250,000 is the minimum there, and that's, you can't do it in IRAs, 401ks, any of that stuff. So it has to be straight cash. So not everybody has that amount, but if you have that amount, it's a great strategy. Okay, donor advised fund. So from the tax code that you have the standard deduction. And with Tax Cuts and Job Act 1, that went up to 31,000 ish for a married couple. And now it increases a little bit with the Big Beautiful Bill Act, a little bit higher. Well, with that, we saw that it was harder to, if you bought a house thinking you could itemize because of all this interest you're paying, you had the standard deduction moved on you, and you're like, well, nope, that's not happening anymore. So yeah, and honestly, if you have a house in the 400 to like 900,000 range, that exactly happened to you. Um, so now to be able to capitalize on that, you got to buy kind of a heck of a house up in the 1.5 or above. Interest rates are helping you in this case because they're higher now, so you have to pay more interest. You consider that a plus. But yeah, so it's kind of gotten rid of that. So same thing with donating to charity. Used to be like, well, I'll get a bunch from my house and then I'll give some money to charity. I'll be able to write that off. I'll itemize. Okay, So what a donor advised fund does, if you are in a position, so what positions you should be in to give money away, that's a personal choice. But I would say if you start giving away like 10K a year, you probably need to be around a million and a half. That's me saying, hey, be selfish, look out for yourself first. But if you're inclined to give it away, or you've got 5 million to where you're not worried about peeling off 10,000 a year or so, instead of doing 10,000 a year to your charity or suite of charities, if you will, you can front load that 100,000 now into a fund, and then tell that fund, much like a trust, to give 10,000 away for 10 years. And by front loading it, you do get that big itemized deduction. So there's your tax advantage for the donor advised fund. So if it's money you're going to give away anyway, then you can bring it forward into current year, if you will. When would you do that? Maybe if you sold a business or whatever, where you have a bunch of money and you're trying to mitigate the taxes. It's just one of the ways you can do that, and you support charities. This is also, so the downside is the money's gone. There's no, "Hmm, wish I hadn't have done that." No, it's officially gone. Where if you do 10,000 a year, you can always stop doing 10,000 a year because something changed in your life. But that's where you can do it, or you can set these up upon your death. A lot of endowments are set up like this. So you say you're worth 3 million or whatever you're worth at death, and you say I want 10% of that to go to charity every year until it's gone. It's still a managed investment account, so in a skilled manager's hands, you might be able to outgrow that 10% every year, so the account might last a long time. Or if you set it up where I want whatever gain out of the fund that year to go into these 6, 10, 15 charities. If there is no gain, then don't donate. Then it can actually literally live forever. So you can put your name on it, and you are now giving away forever. So this is kind of how they do that with the donor advised fund. Acceptable assets, most people think you can give stock that's appreciated, or like Bitcoin. Anything that's appreciated, you can put it in and you can donate it, because you're like, I don't want to pay tax on that. So you don't have to take 10,000 out of your bank account or 100,000 out of your bank account. You can put in appreciated assets. So if you're going to do this, that is something we definitely go through your asset list and make sure that we're picking the right things to put in there. But once it's in there, not yours anymore. So okay, so you create it, you make the taxable donation in current year. You set all the legal structure in place for the account. At that point, it is not your money. They're executing whatever orders you gave the manager, basically, to be able to execute that. And then you can continue to grow it. It does its own thing, and then supports nonprofits or grants. They have to be official 501(c)(3)s that Schwab has heard of. So not somebody's bourbon fund. So it has to be an actual charity for it to be approved. Okay, the next one, again, on you think back to the big chart, this is the fourth one down. This is a very common one. Is when you think about your situation here. Nobody in here is old enough to be in the situation yet, but when you hit 73 or whatever your particular age is, where you have to start taking out of your IRAs, that's probably literally across the board. Client says, like, that's money I don't want to take, because every time I have to take out of it, I have to pay taxes on it. And I already have like all my other things going. I just don't want to have to deal with that. Well, a way out of paying tax on that is, if you're older than 70 and a half, you can donate whatever you have to take for your required minimum distribution, and just donate that. So my parents do that. They're like, we don't need this money. We don't want this money. Certainly don't want to pay taxes on money that we don't want or need. So therefore, boom, here it comes, off to the charities. The Schwab cuts the check directly to the charity, so it never touches your hands as the taxpayer. So that keeps it clean and within the IRS rules. And yeah, it's a pretty good, when you think of, if you've ever looked at it's probably a nerdy thing to do, so I don't blame you if nobody raises their hand. But if you look at like what kind of required minimum distribution you have to take when you're like 85, 90, yeah, it sucks. If you have generated a significant amount of wealth, you can get enough to where you're enough income where you're moving tax brackets when you're not working and haven't worked for 20 years. So a good place to be. Yes, I hear you. But kind of problematic when you're thinking like, this is my tax minimization time, right? When I told that I'd pay less taxes in retirement, sometimes not. But this is exactly what you would do to be able to manage your taxes there. Oh, Irma. If I said that and you know about Irma, you just had an emotional reaction. Um, so again, Irma does a 2-year look back on tax. If you don't know what it is, Just stay in your happy place until you turn 65, and then you will learn all about it. But yeah, it's where the Medicare premiums just skyrocket if you have not even significant wealth. I mean, if you have just like normal wealth, you're going to start paying a lot more. So again, if you're giving away the money, it doesn't increase your income, so therefore it's not increasing those IRMA premiums that you're going to pay. I'd be hopeful that that law would change someday because it's so terrible, but I don't think so. Um, okay, QCD versus RMD donation. So again, you want to go direct from your account. So Schwab cuts the check to the Wounded Warrior Project instead of if you take it, then donate it. We just paid taxes on on that, and then you'd have to try to itemize your donation that you made. So do it smartly. Think about learn about it before you pull the trigger on this. But it's very easy to do. There's a math example. We won't go through that. It's not huge savings, but it's worth taking the time to do. It's even better for clients because they can just tell me to do it, and then it's my time, not theirs. Okay, the next one deals with real estate. 1031 exchange used to be like you had to be a complete real estate professional to understand it or execute it. Now it's becoming a lot more commonplace. So basically, you have a investment property, not your house. Can't do it with your house. This is not investment property because you're living there. But if you have an investment property, not a second home, you have to be renting it out, income, Schedule C, LLC, those sorts of things. If you have a big gain off of that, you don't have to pay taxes. You can roll that as long as you buy a bigger property. So the government wins because that's people just continually investing to avoid taxes, which is making more money. And eventually you will pay those taxes or you will die. So they're counting on that eventually you're going to sell. But it allows you to do that. That's the 1031 piece. The 721 piece has been around for a while, but it allows you. So the problem with the 1031 is the bigger property aspect. So if you're doing this every 5 years, you're thinking, it's no big deal. Well, pretty soon you've got like all this property, right? A lot, like millions in the property tied up. Well, the 721 exchange allows you to 1031 into a fund. So the bigger, better property is just a package of properties. You hold it for a certain period of time and then you exchange it for limited slices. So think shares of the 721. So then you're a limited partner of that. So now you have shares of a property. The problem with the 1031 is when you're 80 years old and you have all this property, you're wealthy on paper, but you're like cash flow broke because you can't access it. And you don't want us to do it because you're going to owe hundreds of thousands in taxes, right? Well, the 721 exchange allows that to go into limited partnership shares. So you can choose out of the 3 million that you owe or that you own, you can sell 20,000 of it. You can choose your tax bill, if you will. Whatever you pick, whatever you sell out of those shares, you're going to pay taxes on. But at least you can choose it. It's not an all or nothing transaction. So it's pretty slick. And especially if you have multiple properties. And a lot of people who are like, well, if you're the person to have multiple properties, like you're going to know all this stuff. And I will say, I hear you. Where do I deal with it? When you inherit it. Like, yeah, that was mom or dad's thing. Now all of a sudden I'm sitting there, they just passed, and I'm like, what do I do with 5 properties? Maybe not even the state I even live in. It's like, well, you're about to get really smart, really fast on all this stuff, or put a team together and we will help you go through it. So again, relinquish property, you sell that, you can't touch the money unlike, and so this cannot be tomorrow's idea. So the second you close, at closing, that has to go into escrow for moving into either another 1031 property or a DST, which is the fund if you think. If you touch it, it's over. You just bought the tax bill. So think about what you're doing, educate yourself, and then bring in a professional should you choose to kind of help you walk through this process. But it goes into the big property, that's the fund, and then eventually you get shares, and then you can choose to buy or keep or sell your shares, or another thing. So you have all these properties, you sell them, you put them into the fund, or if say you don't sell them and you pass away. Well, you got 3 kids, houses don't chop, right? So yeah, and a lot of times none of the kids are in a place to buy the others out. You know, it's one thing if you can pull out an Excel spreadsheet and everybody does okay, I'll take the house or I'll take the property and do that, and it works. A lot of times, if the numbers are big enough, that's not going to work, right? So this allows you to, once you get over into the shares, then cookie cutter, 3 kids, 3 ways. y'all figure it out. Here's your shares, and they can choose to sell them or not and incur the tax bill or not, that sort of thing. So that is a definite advantage. So the UPREIT is the technical term. So the umbrella partnership real estate investment trust is what you're doing there. Okay. The cons, yeah, it's really 6 years from start to finish, 3 years into the DST 1031 portion and 3 years and 721 before you can do all that. So you don't want to like, this is a good idea because I'm terminal in like a year, right? So you want to set this up early, sort of thing. And yeah, you lose control of the operations, but most people are not worried about that. They'd rather save in taxes. Okay, last one I'll cover, and then we'll wrap up with some questions. So be thinking about those, and be prepared for me to say I don't know a lot because this is again the surface level. Michael's here to answer every single detailed question that you have off the cuff, of course. So 351 exchanges, really think of highly appreciated securities. You worked for Dell your whole career. You step off and you've got literally your house and some stuff and 2 million plus in Dell shares. You're like, well, good for you. You got a lot of money, but they're also, you either got them at either low or no cost basis. So yeah, it's pain if you want to try to sell any of those shares, you're going to get hit with a ton of taxes. Well, there's a way to deal with that through the 351 exchange. I haven't done it and I haven't had to recommend it to anybody, but basically you can put it into a fund, and by putting it into a fund you fall into ETF index fund rules. So we talked earlier about the S&P 500 and how it buys and sells every day, and does all this little math, and nobody has to pay taxes on any of that because it's inside of an index fund. So this puts the 350, puts your appreciated stock holding in there. It builds a package around it, sometimes using cash too, and then that way it can do its maneuvering within a fund wrapper to be able to lower the position and basically get all of your net worth, reduce the level of net worth you have in that single stock. It could be the same thing if you inherited a bunch of AT&T stock like my family did from the 80s. So I mean, a lot of times that can be good or bad when you have that big stock position. If it's going great, then everybody's happy. When it's not going great, you kind of wish you didn't have everything in one basket, if you will. So that's an option for you. All right, I will pause there for questions. I can't see the questions online because I don't have anybody monitoring. So if you do ask a question, I think I'm able to see it once I stop the live stream. But thank you for the home listeners for listening. And you may have a question here. If you ask one, then I'll repeat it so the people at home can hear it. So who wants to ask a question? Okay, I'm gonna let everybody off the hook then. No advanced tax questions. Of course, as soon as we hang up, then there'll be the tax questions, right? So thanks, everyone. Do you have one? Yeah. All right. Correct. So, great question. So the question is, if you choose to do the direct indexing thing, which is a 250,000 min, it does say 100,000 min, 250 recommended in order to generate enough gains. So I say 250,000 min. So the question is, how long do you have to leave it in there? Are you tied? Do you have to leave it in there forever? That sort of thing. Well, when you can think of the volatility within an index, you're going to get most of uh, your loss capture in the first year, because there's always, out of the 500 stocks, some of them are going to go up and never look back. Some will not, and some will get replaced with others that will go down. But eventually, when all of them are up, think 2 to 3 years down the road, you've squeezed about as much loss out of that as you can. So at that point, you can either sell that or keep that. But if you're going to want to generate more losses, you would have to put more money in. So, and it seems like, and I hate things where the solution is the money guy says, you just got to put more money in, because it seems like, but that's just how the math works. So you're going to get, so when you think of about 250,000 over the course of a 7 year period, my guess would be you're going to get about $35,000 of total losses generate out of that while it tracks the index. But it is your money at any point in time. You could take it out, and if you do, then you would owe taxes. So if you put 250 in and then you hold it for 3 to 4 years, you generate some losses, but then you sell it. If it's up 20, 30, 40%, then you would have to pay taxes on that. So great question. Other questions? All right, Terrence, you're up next. Mhm. Ye- Correct. So the question is talking about the design normal S&P 500s in an index. So all the buying and selling is tax free. In other words, nobody gets a capital gain form at the end of the year out of that. What is the difference with direct indexing? Um, and the difference between that and the overlying index. So with the index, if you're inclined to say put $250,000 into the S&P 500, if that's your risk level, which is not everybody's, but if you're like, I want full market risk, take 10 to 12% up over time, sometimes 50% down, 2008. You got to be able to stay with the ride. But in there, it's very tax efficient. It tracks the same. If you go with the direct indexing, the same $250,000, it's going to follow that index, even though it's exchanging property or exchanging stocks within the index. It's selling Pepsi and buying Lockheed Martin, and then selling Lockheed Martin and buying Kraft Heinz. It's doing a lot of things behind the scenes, but the overall result, if you take the S&P 500 and chart it, should do that way, um, chart it, then nope, that way, then yours would be right along that plus or minus 1%. Does that answer your question? Not sure I got to it. Yes, if you buy the index fund, there will be no tax implications until you sell. With this, by it selling within the fund or by it making actual moves in your portfolio, you are extracting those losses. You, yeah, Yeah, the question is what fund? It's really any of the recognized funds. So the one I chose to use for the client, they didn't have any small cap exposure, and they had lots of large cap exposure. So that's S&P 500. So I picked the S&P 600, which is the small cap version. So or there's another name for it, but it was the small cap 600 stocks. So they could have specific exposure to that. So, sir, it's something. Yeah, the question is what sort of index funds? It'd be anything that you've heard of. So the 2000, the Russell 2000, really any of the top like 40 funds that you've heard of, it will track that. It will not track the reverse Pelosi, or the reverse Kramer, or the Pelosi tracker, or any kind of the off the wall type things. So, got one more? Yes. So the question's on QPTTs. Are you talking about the qualified properties that we talked about last time where you're taking the house? Ah, yes, correct. Okay, I got you. Yes, the question is the qualified charitable distribution. Can that be used for college? And the answer is no. It has to be a true charitable organization. Now, there you can make lots of jokes about colleges charging so much. It's like they think they're charities, but no, you cannot offset it for education expenses. So the question is, do they have to be US based charities or can they be international? I would imagine, this is me guessing, I'll have to look it up and let you know. I would have to imagine it'd be international, but I would think it'd be broad international, World Health Organization. I'm not sure it would be into the Peruvian. Yeah. Yeah, it might be domestic domiciled. So that's something we'd have to Google that. I don't know that offhand, but I think it'd be worldwide impact, if you will. So excellent. Michael, any misspeaks you need to correct me on while we're still on camera? Are you polite enough to save till we till we hang. So, all right. Thanks everybody for listening in. Please feel free to stick around and hang out for a bit. You can clap. It's okay.